Joining me now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, it's a great question that the Journal asks today. Why cut rates now if we're expecting the economy to get a boost from all these pro-growth policies that President Trump is going to be bringing in?
I couldn't agree more. I don't understand why they're going to do this. Here's what bothers me. I worry that we're going to see expanding GDP next year, which I'm not worried about. It's going to be great. We've got a pro-stock market president. I worry about inflation picking up next summer. And it could be sooner. It could be this spring. And if it does, markets are going to freak out. The only thing good that that's going to do is it's going to scare people. The Fed might have to then not just stop their talk about cutting. They might have to say something like, do they need to raise rates at quarter point? That would be a disaster. The only people who would win if the Fed had to start raising next year are people like me who are going to pick up 30-year treasuries at a discount for a good trade. So I think we really have to look at this. Plus, we're going to see PCE end of this week. How high is it going to be? I don't think we're going to see it going lower. And also, just look at things this week that we're going to find. We're going to see retail sales in a few hours from now. I don't think that we're going to be weak. And also, when you look at housing coming up this week, I think it's going to be a problem. So I think the Fed's going to really have to explain to markets what they think is going to happen next year. And I think those betting on big forward rates, I just don't think the cuts are going to happen.
Well, I mean, look, we know that we're dealing with a consumer that is stretched, right? They're putting sales on their credit cards. We'll get the November retail sales out today at 8:30 a.m. Eastern. Economists are expecting month-over-month sales to be up 0.5%. And when you strip out auto sales, it's expected to be up 0.4%. Then we'll get the November housing starts and building permits out tomorrow, followed by the final read of third quarter GDP on Thursday, and the Fed's preferred inflation measure on Friday, the November PCE index, Lee, coming out on Friday. So how does the economy look to you now? What are you expecting from these numbers? And how soon do you expect a change in terms of growth?
Well, I think we're going to start seeing growth all the way into the first quarter of next year. Markets, I mean, think about all the animal spirits that are going to be unleashed. Think about the M&A activity. Think about all the pent-up activity. There's a lot of CFOs that didn't want to make decisions prior to the election. Now that we have a clear view of what regulations aren't coming down the pike, we have a clear view of what kind of deficit spending that we're going to have. I think that all of that ends in a hotter economy. And I think with the idea that the Fed, first of all, we felt that the Fed's been restrictive this whole time. It hasn't been as restrictive as we thought. Why is the stock market up so much this year if we're supposed to be in a restrictive policy? I think the Fed hikes were barely restrictive, and I think that we're really going to have to take a pause next year because, again, we're having good times. The stock market is going to be growing earnings at, low double-digit rates. I don't see why we need to do this now.
What do you think, Chris McMahon? Jump in here.
Lee, you scared me a little bit when you said possible increase in rates next year. I think the market would have a hard time digesting that, at least now. But as you think about it, if the market freaks out a little bit in June, as you're thinking, if we see that, if 3% freaks the market out, there's really two questions I have for you. One, I think we need to have mortgage rates at 5%. I think we got to come down a little bit more. I see at least a couple of cuts next year to get us down there to spur the housing market. And secondly, just in general, what do you think it has us avoid this trap of inflation? Those are the two things I was thinking I wanted to ask you.
Well, I mean, believe me, just for full disclosure, I'm long D.R. Horton, so I really do want mortgage rates to be going down. Right. They just that's all I want for Christmas. But I was also the son of a mortgage banker, and I know how this works. I don't think we need mortgage rates to go down. I understand for young people, millennials, they would love this. But when you look at it, let's look at existing home sales and what new home sales are going to be later this week. Home sales are going to happen because people need that. And if you ask a baby boomer about, how do you feel about young people having 7 or 8% mortgages, they'll kind of snicker at you. I think the only thing that we can do with inflation is we've got to give it time. Inflation is going to work out of the economy. I don't think there's a lot of policies that we can do to remove that. The issue is that we're going to see, if we see inflation next year, markets are going to like it. I think it's going to be very difficult for the Fed politically to actually raise rates next year. So the real game is not having less restrictive policy. The thing that's going to bring inflation up is having loose policy next year and getting the, Trump is going to do enough to make this economy go forward. We don't need the Fed helping. We don't need to add more fuel on it. We need just to find that right balance. And I'm worried that the Fed is going to stretch at the wrong time, loosen money at the wrong time, and it's going to screw up this little magic machine we've got.
So